Hello and welcome to the latest episode of Damien's Midweek Markets, the show where I talk about what's been going on in investment markets and what to look out for in the days and weeks ahead. Now, inflation is all that's been on investors' minds this week. If we start in the UK, where the Office of National Statistics today announced that inflation had risen to 3.2% in the year to August, up from 2% the previous month. Now, although the ONS warned not to read too much into the rise, citing it as a temporary increase, it is the biggest jump in prices since records began in 1997. It's also the highest inflation reading since 2012, when inflation, as measured by CPI, hit 3.5%. But the difference back then was that inflation was on its way down. Now, despite the surge in inflation, UK gilt yields barely moved. Logically, you may expect yields to rise alongside the expectation that the Bank of England may have to raise interest rates sooner rather than later to quell inflation if it becomes ingrained. It suggests that the market is buying the temporary inflation narrative in the UK. But not only that, the Bank of England had previously warned of a temporary spike in inflation as high as 4% in the latter stages of this year. Now, the impact on equity markets can already be seen. So the FTSE 250 fell around about 1% today after the inflation news broke. Now, that means it still sits only just 3% below its all-time highs. Interestingly, just a day earlier across the pond, inflation data in the US surprised to the downside. Headline US consumer prices rose by 5.3% in the year to August, which slightly undershot economists' expectations of 5.4%. The surprise miss saw the 10-year US Treasury yield capitulate and fall from 1.3% to as low as 1.265% on Tuesday. Now, the narrative had become that inflation was possibly cooling, and that reduced the pressure on the US Federal Reserve to raise interest rates or cut its bond buying QE program before the end of the year. Bonds were therefore bought and yields collapsed, and equity markets began rotating again in favour of this stagflationary trade. Indeed, recent economic data in the UK showed that economic growth disappointed as a result of the pandemic over the summer, while the Chinese economic data showed that its economy had slowed down, and that slowdown had worsened as a result of August coronavirus outbreaks. Indeed, the impact of COVID tends to show up sooner rather than later in Chinese economic data due to the swift and aggressive crackdown measures that its government enforces whenever there is an outbreak. In the West, the impact and recovery from a pandemic control measure is typically much slower to become evident in the economic data. But it all means that the market position turned back towards one preparing for stagflation. So the usual suspects such as tech stocks, REITs, that's real estate investment trusts, and utilities outperformed energy stocks and financials. We even saw gold break back above $1,800 per ounce. The US 10-year Treasury yield has since rebounded to 1.26%. Well, actually, it's now up to about 1.29% as I make the show. But for now, it sits below that key level of 1.3% and calls into question the recent short-term trend of rising interest rates. Similarly, unless the yield falls below 1.26% to 1.27%, that 6-month downtrend we've seen in yields has also been broken for now, and it seems that the bond market is looking for direction, with participants clueless as to the future path of inflation and central bank monetary policy, particularly from the Fed. However, last week the ECB, so that's the European Central Bank, did play its hand and reduce its QE program, but went to great lengths to say it was a recalibration and not tapering. The can on tapering was kicked down the road until December, but it means that the market was appeased even though the starting gun was fired on monetary tightening on the continent. In fact, European stocks are up this week, albeit around about 0.2% in some cases, but as high as 1% on the German DAX. Now, the UK stock markets are up around about, similar amounts. They were up about 0.2%. That's for the FTSE 100 and the FTSE 250. But after those inflation figures, they did dip to be broadly flat and marginally down in some cases. But it will be interesting to see how the UK inflation reading impacts the market's predictions on when the Bank of England will raise interest rates. I mean, the day before the announcement, the yield curve was pricing a rate rise by the Bank of England to 0.25% by the end of the first half of 2022. So how this will change, we'll have to wait to see over the coming days. But bond and equity markets overall are pretty messy at the moment, with participants trying to second guess central banks and the future path of inflation and economic growth. And this is starting to take its toll in US equities, where for 5 straight days they ground lower before some respite. For example, the S&P 500 is down 1.45% over the last week compared to a 1% gain in the German DAX. Now, such divergences between the two are quite unusual and something to keep an eye on, because normally one way or another something typically gives. But the UK and US markets will likely gain some certainty next week when the Bank of England and the US Federal Reserve have their respective policy meetings on the 23rd and the 22nd of September. So things could get interesting. So that is it for this week on Damien's Midweek Markets. As ever, you can contact me via email. Damien@moneytothemasses.com is the email address. Twitter is moneytothemasses with number 2. You can find us on TikTok, Instagram, Facebook, and of course, don't forget to subscribe to our YouTube channel.